Hi, I'm Josh Brown from Ritholtz Wealth Management. I'm here today with Bill Sweet. We have seen a new record high in the stock market this week for the first time since the end of January. A lot of people have a lot of opinions of what this means. We're going to break it down for you and share some stats that I think are going to blow your mind. Stick around. So I have Bill Sweet with me here today, and Bill did this epic tweet storm about the fact that we've made a new all-time high, and Bill went through all of the best posts that we've done as a firm, blog posts, about new all-time highs in the stock market, and it's a really controversial subject because people have these instinctual reactions to seeing record high prices being paid for anything, anywhere in the economy. The stock market probably provokes one of the most visceral reactions. Why do you think that is, first of all?
It's emotional, and people see something at an all-time high. The only thing that's ever happened before then is the price has been lowered, so they expect a crash. That's what you fear.
Right. So you just say, oh, I don't want to pay the highest price anyone's ever paid.
Yeah, there's a great post of yours from 2014 about the psychological barrier about buying into an all-time high.
It's the worst feeling on earth.
Exactly.
Until 3 years later.
Right. The prices have never been high.
Yeah, the only feeling worse is if you don't. So all right, so I want to go through some of these individually. So it's March 2017. The Dow breaks 20,000 for the first time. And Ben did this thing. He took 100 years of data, pretty much. The Dow Jones going back to 1915 through 2016. Stocks have made over 1,250 record highs in that period. And that's an average of 12 new highs every year. So Ben's saying, think of like a regular person has 40 years to invest, like an investing career of a human being. That would be something like 500 new highs experienced in a lifetime. I don't think a lot of people think of it that way.
No, one per month.
One per month, imagine. And then he was basically saying that's like 5% of all trading days of your lifetime, you would be seeing a record high in stock. Now, of course, it's lumpier than that. It doesn't average out that way, which is why people have so much trouble with it. But I think this is the key point. On average, the Dow Jones makes a new high. It's up 21%. Again, on average, and averages are formed by a very wide array of data points, but it's up 21% 3 years later and 32% 5 years later. Not a lot of people think I'm going to buy an all-time high, and on average, 5 years from now, I could expect to see the market a third higher, but that's actually what the experience has been over the last 100 years. And you have positive returns about 70% of the time, which I think is consistent with all market periods. About 70% of the time, you should be higher a year later, 3 years later. Would you say that's pretty accurate?
Most of the time, the market moves higher. It's
All right.
The rewards of investing.
All right, so let's go beyond that. Michael did this thing in November 2016 as the Dow broke 19,000. So that's November of 16. It feels even more unlikely because it's right after the election, the very contentious election.
Oh, yeah.
So the Dow's breaking through 19,000. And he actually looked at the S&P. And what he found out was that on average, when you make a new high in the S&P, you're up 7.8% 1 year later from making that new high. And that actually compares to up 7.5% on all other days. So not only are you up almost 8%, that's actually better than you do when you're not buying a new high. And I think that's very counterintuitive.
About 30 basis points. I use this stat a lot with clients to say that the market performance following an all-time high 6 month, 12 month period, again on average, is higher than it is on every other time.
What percentage of like prospective clients, people who aren't yet in the cult, but you're speaking, like what percentage make some kind of comment about the fact that we're at record highs? Probably most, right?
100%.
I would too.
Yeah.
Okay. And then Mike was saying 18% of all months going back to 1926 have seen the U.S. stock market close at a record high. So almost 1 in 5 months out of that whole sample size. It's 90 years.
Yep.
I want to do one thing that I said, and you linked to it, so thank you. January of 2015, I did this thing about new record highs and Bugsy Siegel and how the Mafia discovered this wonderful psychological concept that has since been written about officially and scientifically called the gambler's fallacy. And the gambler's fallacy is like you're at a roulette table, you see the wheel land on red, 8 times in a row, and you have to put it all in black.
Yep.
How could it possibly be red again?
Right.
Same thing with a coin flip. But mathematically, math doesn't care. So there's mean reversion. If you you spin the roulette wheel, roll the dice, flip the coin 10,000 times, you'll get closer to some average. But in 1 year, 3 year, 5 year increment, right? I mean the mob discovered that by accident. They were watching idiots pump money into slot machines, and they just said, "Oh, these people really don't understand how math works."
Right.
And they had this kind of street smart math. And Las Vegas ends up being built on this premise. Everything that you see there now comes from this one very simple idea. You're not a big gambler, right?
Well, when the time's right. But the thing about investing is the odds are in your favor. It's not timing the market that matters.
Versus Vegas.
Exactly.
Where the house has an edge.
You get free drinks.
Yeah.
But it's timing the market. The more time you spend in the market, the better your odds are for a positive investment return.
I want to get into the one that you linked to from Nick.
It's great.
And that's from just June of last year.
Yep.
So in June of 2017, Nick looked at a proxy for the S&P 500 going back to 1880. Of course, the S&P didn't exist until the 1950s. Right. But the 500 largest U.S. stocks on a century and a half timeline. How many times have you seen anything like that? So that's 1,644 months worth of closes for the data set. 356 of those months were all-time high closes. So that's 22% of all months over a century and a half. The reason that's slightly higher is because he did total return.
Right.
So dividends have a big impact on that, which I don't know if a lot of people realize. And then another one you linked to, Michael Batnick found that hitting a new record high in any 1 month made it more likely, statistically, that you would hit another high the next month. These are the numbers, and then I want to hear what you have to say about this. So you had a 67% chance of hitting a record high the following month after breaking a record in the current month. And then if you did within 4 months, you had a 90% chance of following a record with a new record. 90%. Does it get better than that in investing probability?
Right. Back to that post that Nick Majuli put together, out of the 356 months that had a positive return, 90% of the time, 4 months later, you had another all-time high being formed.
Right. How many people are even thinking that way?
Exactly.
Right. So if you have this gambler's fallacy where you see a new high and your immediate reaction is, well, that's the top, it literally works in the opposite direction.
Yes.
I mean, eventually it will be the top, but statistically, the odds of this being the top, just because you made a record high, it literally works in the exact opposite direction. So stop doing that. July 2016. So this is an interesting period. This is just as the bull market that we're in now is about to resume.
2 years ago.
Yes. So this is Brexit, and then boom, global markets take off, the U.S. included.
Yep.
But this is after a 285-day period of a flat market where we go nowhere. And a lot of people have forgotten about this. And that streak, 285 days without a new record, was the longest period of time we've experienced like that since 2007. So we really just were grinding back and forth, going nowhere. And then we break out. And Michael notes that despite all of the trauma of elections and economic catastrophe and war and various crises over the last century, U.S. stocks have managed to make a new record high in all 7 of the last 7 decades. I don't think a lot of people are even aware of that. So in every one of the last 7 decades, back to the 50s, we've seen at least one new high. But back to what I was saying before, it's very lumpy. You only had 13 new highs in the 2000th decade, which was torture. I was there. You only had 35 in the 70s.
Yeah.
But then in the 1980s, you had 190 new highs. In the 1960s, you had 224 new highs. You had 313 new highs in the 90s. And the decade that we're in, already over 150. You have a prediction on how many we finish with?
No way. No prediction free podcast.
You got a year and a half to go.
You got it.
You did this thing about you linked to this thing from February of this year. Michael talked about the correction we were in the middle of.
This is the end of that streak.
So you were talking to clients.
Mm-hmm.
What was that like this February after so much tranquility and then all of a sudden we get this 11% drop in 2
Yeah.
weeks.
Yeah, so for a lot of people, it was paradoxically a bit of a relief in that the streak ends and we're back to having conversation about the markets not being at all-time high. And I called a lot of my folks that I've been working with and said, this is your opportunity, not knowing what would have happened, but to say, if you've been waiting for a pullback, it came, not knowing what would the
And
future
everyone was
gonna
waiting
hold.
for a pullback.
Right.
So here's what that streak was. Again, this is from Batnick. It was 202 days that the S&P 500 spent 202 days within 3% of a record high. And that is so hard to watch day after day, whether you're long or not long. And then in the beginning of February, late January, we had this 4% down week, which freaked everyone out because it hadn't happened in so long. And we had a 2% down day, and Mike wrote that day, basically said, look, we've had 17 down 2% days over the last 5 years. Nothing to panic about, happens all the time.
Yep.
Very, very standard feature of being invested in equities. And now those levels, when Mike was writing, so this is the week that we broke out above those levels. And if you were reading people like Ben, like Michael, and not reading people who are innumerate or don't understand that they themselves are falling prey to the gambler's fallacy, or people who aren't aware of market history, like if that's who you're taking guidance from, what do you even say to someone who doesn't understand that they're barking up the wrong tree and consuming the wrong people's opinions?
There's, again, to give you credit, a post he wrote back on Monday prior to all this happening, which is a portfolio is not a plan. And that's why we advocate so strongly for a financial plan. A financial plan is going to dictate what you should do in up markets, down markets, and give you the guide path on how to invest going forward.
Somebody give me one more. I'm done with both. This is Barry this January talking about 2017.
Yep.
Because I think that bull markets are just as disruptive to investors as bear markets.
I'd agree.
And we talk about this a lot. But so Barry in January of this year did the postmortem of 2017, which is a great year for our client. Pretty much anyone that's a rational investor did very well last year. But it was a total grind.
Yep.
So you did the single largest one-day gain of 2017 for the S&P was only 1.38%, and that is very low historically. The biggest drawdown, though, the mirror image of that, was also tiny. The most we were ever down last year from the high was 3.4%. So that's that grind.
Yep.
That we're talking about.
It's a great thing that Michael wrote on that topic. It's the greatest challenge in investing a lot of the times is finding reasons not to sell, is finding reasons to hold on to that.
That's such a great point. Right. Like I can make a list of 20 things why you should get out right now.
Yep.
What are the reasons why you shouldn't? Well, I think we've reeled off a bunch of them.
Yeah, right.
But so if you think about last year, you had another streak that was driving people crazy, or maybe it was the same streak, phrased differently, 13 straight months of an up S&P 500, which is the first time we've seen that since 1959. People were losing their mind over this monthly streak, but you had a green S&P. But again, returns were only 27% over that 13-month streak, which if you compare that to the average return of previous 10-month streaks for an up S&P, looks more like 50% or more. So you got about half of what the average return would typically be from a streak like that. So you think about 2017, it's not outrageous at all that we did up 20-something%, given how many months consecutively the market was up. And we can get into earnings went up during that period. We can get into rates continued to have been normalized that period. There were a lot of reasons why that should have happened, and it's good that it happened. And a lot of political risk maybe came out of multiples. But look, nobody is saying that this stuff is easy. Records exist, and then they get broken, and people freak out. But I think context is, for me, that's my main takeaway, and I think that's what you try to bring to your conversations with people all the time, right?
Absolutely, and returns are lumpy, and so that's why staying invested is so difficult, but you have to do it, because if you're not there when the market turns, you're doing a lot of damage to your portfolio and your plan.
Bill, you're the man. Thank you for joining me.
Let's do it.
Michael, we'll see you next week.